The Rebel Capitalist Show. All right, guys, it gives me a great deal of pleasure to welcome someone to the Rebel Capitalist Show that I've really looked forward to speaking with. I had the opportunity to meet him at Simon Black's event. We really hit it off. We kind of did a macro panel discussion. So we're bringing him on today to the Rebel Capitalist channel, or the George Gammon channel, to discuss, kind of take that macro discussion even further. And there's going to be a two-part series. So we're going to do a discussion for the next half hour, and then we're going to do the second half of the discussion on Adam's channel. So Adam Taggart, welcome to the George Gammon channel. Welcome to the Rebel Capitalist Show.
George, it's a pleasure to be here. I've been a big fan of yours for a long time. Really enjoyed meeting you in person out at the Simon Black event, and very excited for our own conversation here today.
Yeah, for my viewers who might not be up to speed with your background, can you give us kind of the Reader's Digest version there?
Yeah, absolutely. So first off, I run a company called Wealthion, which is very similar to what you do with your YouTube channels here, where I interview some of the best minds and money in the market every week, trying to help people understand where we are in this current journey, in the economy and the financial markets, particularly during this really sort of confusing time for investors, trying to help educate people and inform them so that they can make better decisions about how to build their wealth. The Reader's Digest version of my background is I got my start working on Wall Street as an investment banker in Manhattan. Stayed there just long enough to know I really did not like the culture, and that Wall Street existed to serve its own needs and not those of its purported clients. Then went and got an MBA from Stanford, worked in Silicon Valley for a number of years, worked at Yahoo for about a decade, but really was spent most of my time outside of work reading the blogs of a lot of the people that you and I talk to in our interviews these days, who were warning back then about the housing bubble and about the malinvestment that was going on, and warning about a correction. Right. And when they were proven right, I really wanted to help wake up more people to kind of the fundamental causes of what was going on, because as you and I know, a lot of the main root issues just kind of got papered over, somewhat literally, coming out of the great financial crisis. And so I left Yahoo. I ended up starting a company called Peak Prosperity. I know that you had Chris Martenson, who was my co-founder for that venture, out at one of your events relatively recently. Anybody that's familiar with Peak Prosperity knows it's all about building resilience, given the big macro trends that are going on in this world. And what I found during that process is, there's a lot of big issues that we need to worry about. Everything from resource depletion to societal structure, all sorts of things going on right now with personal liberties. And you capture a lot on the Rebel Capitalist channel. But I found that kind of the gateway drug to all of that was financial literacy. That there's a ton of people out there who are motivated one way or another by protecting the people in their lives. They want to provide for them financially. They're working hard to build wealth. And in their guts, they know that something's not quite right out there. And they're afraid that, what's going on in both these unsustainable markets that we have right now, as well as kind of our sputtering and over-leveraged economy, that there's a real danger of them kind of becoming collateral damage before they get to the finish line that they're shooting for. And so I found that if I could meet people on that financial discussion, I could then open up their minds to all the other issues to talk about. And that's why I launched Wealthion, was to be able to bring in many more people through that financial door, open their eyes, and then hopefully be able to, over time, let them know that, hey, there's a whole bunch of other ways to build resilience as well, besides just with our money.
If you've got someone who is your prime target there, kind of the average Joe and Jane, they don't have a background in macro. They don't really understand Keynesian economics or Austrian economics, or they haven't studied Milton Friedman or anything like this, or maybe they didn't really study the GFC. How do you present the macroeconomic environment to them, kind of in a step-by-step process to not overwhelm them?
Yeah, that's a great question. Because you do a great job of educating as well, George. And it really is kind of you got to try to meet as many people where they are and then build from there. I find it really useful to just sort of use the Socratic method, which is to speak to hey, can you see what's going on with prices in your grocery store? Right? Or, hey, why is all of a sudden, so much of what the things we want to buy, A, more expensive, or B, not even in stock anymore? Right. And then pulling at those threads, because those tend to be sort of universal experiences for people. You can then kind of, begin to talk about the causality of what's actually making that happen. And interestingly, I find that, you got to be careful early on not to overwhelm people with kind of the wonky jargon that you and I like to talk about when we're sitting in a corner somewhere.
The Eurodollar futures curve.
Exactly. Yeah. But people actually enjoy hearing those terms. And you do a great job of this with your whiteboards. I don't have your skill at the whiteboard, but I do a number of what I call sort of explainer videos.
Yeah.
Well, we'll pick a topic and try to explain it within 10 minutes or less, so that people, when they hear those terms going forward, they feel like they've got enough of an understanding to kind of at least follow the story. But the type of person that I speak to, and I imagine there's a high overlap with your audience, George. These are people, most of whom who have built some degree of wealth, which means they tend to be a little bit older. I'm definitely not trying to ignore the millennial or younger crowd, and quite honestly, that crowd needs this information the most because they're going to be the ones dealing with these issues the longest in their lives. Yeah. But I found that these are people who have built some wealth, and they're doing it to take care of those who depend on them. Right? It's their spouse, it's their children, whatever. And that's really kind of their defining motivator, is just, I want to get smart enough so that I can sleep well at night, knowing that I'm doing something smart enough with my money that I'm maximizing the odds of it being there for me, when I'm done. So we tend to skew older. We tend to have a lot of people who are, 45 and older, people who are approaching retirement age or actually retired. And again, it's not necessarily deliberate, but I'm just finding that those are the people who are most concerned about protecting the wealth that they've been working to build.
So it seems like their priority might be capital preservation as opposed to capital appreciation.
Yeah. I mean, be super clear. I'm not, and I don't think you are necessarily either, George, kind of talking to the YOLO crowd, right? We're not telling people when the best time to buy, GameStop calls are, is, or which next NFT is going to be the one to go up by 2,000%. I'm definitely trying to speak to sort of the responsible investor, again, who's really just mostly concerned about just not getting things wrong. We do also, so what Wealthion does is it educates in the way that you and I have been talking about here, but it also then makes that information actionable by connecting people with a network of financial advisors who think look through the same lens, who talk about these issues, who are concerned about them. And I'll tell you, George, it is amazing how many people are frustrated with their current financial advisors. They go to them and say, look, I'm worried about, what the Fed is up to. I'm concerned about the impact that higher inflation might have on my portfolio. I'm concerned about currency debasement. Maybe we should talk about moving some money into hard assets, or maybe even a little bit of gold or silver. And, the average stockbroker out there, basically treats them like they're crazy and says, oh, don't worry about all that stuff. The market's going to take care of you in the long run. Don't worry about that. That's just the doomers. So there's a really sort of pervasive angst for a lot of people out there, right, that they're having trouble finding a good professional steward of their money. And again, that's something that Wealthion tries to help, is connect them with those folks. But it's surprising how badly the current system is servicing their clients.
My biggest concern for people right now, when we're talking about just the financial aspects of life, is the Fed, along with the government, is pushing people so far out the risk curve just to maintain their current levels of purchasing power with their excess productivity, or hopefully their excess productivity, meaning their savings. And hopefully that's not the stimmy checks. Maybe it is, maybe it isn't, whatever. But to protect their savings. I was at Schiff's place over the weekend. And
in Puerto Rico?
Yeah. I happened to be there regardless, and he was having his Christmas party, so he invited me over there. I went over there with Brent Johnson. And I was talking to a guy that was a hedge fund trader. So he really wasn't a macro guy, but really he had done very well in the area of trading, kind of short term. And we started talking about him getting into real estate in 2013, 2014. And he said to me, just kind of randomly, he's like, well, I at that time I knew I couldn't keep my money in the bank. It's kind of nonchalant. And I kind of took pause, and I'm like, he doesn't really even understand what he just said. And subconsciously, he knew that if he kept his money in the bank, that he would lose purchasing power. We've been conditioned to understand that through decades and decades and decades of inflation. Even if it's 2 or 3% compounded annually over 20 years, that's a big number. That's a really big number. That's a big loss of purchasing power. So I thought, back then, the inflation rate, as measured by the CPI, and I know that understates it, but just to give us a benchmark, the inflation rate was, let's say, 2%. And he still knew that he had to do something with his money. He couldn't keep it in a savings account without it losing purchasing power. And I think, what would that same person do today when we've got CPI at, let's say, 7%? Now that same inner dialogue would not be, shoot, I've got to do something with it, I'll go into real estate. Because the CPI is so high, especially if you look at it accurately, you're probably not even keeping up with the rate of inflation if you go into real estate. And then you're going so far out the risk curve that you're having to invest in a real estate market that is in a massive bubble, that even adjusted for inflation is higher than the prices were in 2006. So what would you do? The only other option is to, well, okay, now I'm going to go into the stock market, a riskier asset. Well, what happens if inflation goes up to 10% on the CPI? That's not keeping pace. Well, then you're going to have to go, and it gets to the point where if inflation gets high enough, the only option for these people, even if it's a subconscious decision, is to go into Dogecoin or to go into Shiba Inu or to speculate on an NFT or something like that. That's what the Fed has done to the average Joe and Jane. So you're an expert in this. So how on earth would the average Joe just maintain their purchasing power, for heaven's sakes, without having to go so far out the risk curve as to buy call options on Dogecoin, if that's even a thing, or GameStop?
Well, hey, thanks for placing the weight of the world on my shoulders right here, George, because honestly, this is the plight of literally every investor right now.
Yeah, this is what makes it so difficult.
Yeah, and it goes to the heart of why I created Wealthion, and I suspect to why you do what you do, which is, I call this nefarious. I call it actually criminal. I mean, this is not an accident that people are getting pushed out the risk curve like that. It's actual policy, right? You could say that they're responding to the incentives that the Fed policy is laying out in front of them, but really it's a malincentive. I mean, I think most people would prefer not to play this game if they couldn't. But in eras past, if you didn't like what was going on, there were places where you could just sort of sit in safety on the sidelines.
Yeah,
you can't today, as you just very eloquently said. You can't sit in cash, right? Sitting in cash is, right now, it's a license to lose at least 8% or at least 7% of your money annually, and we know that official CPI rate is understated, right? So it's probably a fair amount more than that. So I kind of liken it to, kind of like on the old pirate ship plank. People are pushed at sword point out on this risk curve because they can't afford not to, at least in their minds, right? So especially the older generations, right? Where in eras past, you could live well on a fixed income, especially if banks were paying 6, 7, 8% like they were back in the mid 1980s, right? Now the average bank savings rate is 0.06%, which is just, it's insulting. And so, to your point, as inflation rises and the real return that you get from anything quote unquote safe becomes more and more deeply negative from a real sense, you have to go out and reach. And honestly, what you just said there, I know you were kind of joking about going after Dogecoin or the next NFT, but that's already what the millennial generations and younger have learned. That is their only chance. If they want to try to have a hope at affording a middle-class lifestyle, they're not going to get there by capital formation. They're only going to get there by a winning lottery ticket, right?
That's a great way to say it. Yep.
Yeah, and what's also nefarious about this is the Fed has conditioned everybody that there is, quote unquote, this Fed put, and that the Fed's going to step in if the markets, get nervous at all. So the analogy I use is the Fed has been pushing people out onto thinner and thinner ice. But because the ice hasn't broken in so long, right? Besides the 4 weeks in 2020 when everybody panicked about the pandemic, it's pretty much been a decade that if you just trusted the Fed, bought the dips, and just bought and held, you've done great, right? So we push people out on thinner and thinner ice, but they now are treating it like it's concrete, right? Meaning, so they are placing their full faith that it's going to continue to hold them. And as you and I know, there are a ton of macro factors that are highly, highly concerning right now. And when people, basically place all of their future prosperity, out on the risk curve where they shouldn't be, there's a way to, discomfiting chance out there that there could be some breakage. And with people being that exposed, the events could be catastrophic, particularly for people that are sort of, 50 and older, who just don't have the time to recover from, say, a 50% correction in the stock market. And, I'm just not pulling that number out of the air. Number of folks I've talked to, number of folks you talk to, think that a correction of that size or even greater could occur. And, and even great minds like Jeremy Grantham, who, one of the most venerated investors around, the guy is not prone to hyperbole. He thinks at least a 50% correction is possible, given every other time in history we've had the same conditions that we have today. So yeah, I'm sorry, George, I know you painted me as the expert. I don't have the answer for people, but I certainly do have a lot of strategies that people can follow to minimize their exposure to that. Maybe we'll dial through those in part 2 here, in case you want to start getting into them now. But it really, I think it's about minimizing loss and risk management at this point in the story. And I like to tell people, look, given what might transpire in the relatively near term, the name of the game might be preparing to lose money. The strategy is just to lose a lot less than everybody else. That might be the best that we can get out of this. There's going to be opportunities at some point in the story to position yourself to prosper. But given the risk level in the system right now, boy, I'm really nervous.
Yeah, you always got to be comfortable to take a negative carry just so you could have the optionality of dry powder.
Exactly. So, you were talking about, cash and how that just gets eaten away by inflation right now. And I asked this question of the guests that I interview, and most of them at this point right now are saying, yeah, it's a guaranteed loss to inflation, but it's got a very high optionality value, right? So let's say your cash is losing it's going to lose 7% for the next year due to inflation, but let's say the market corrects by 50%. Then you've actually done wonderfully relative to where you might have actually parked your assets, right? So, but I don't mean to say that we should all be happy to sit in cash and lose 7%. It's part of that sort of criminality of the system that's been created when that's maybe the best option that's available to us right now.
Yeah, that's why, just for me personally, I try to keep a very simple portfolio of something I call it 10-80-10. So that just means that 80% of the portfolio pays you to own it. It's like a positive cash flowing rental property. Might not be in the United States, maybe somewhere else, a dividend paying stock. So at least you're getting paid with the majority of your portfolio to buffer the loss, the negative carry that you have on your cash position, to take advantage of something in the future if you think the probability is high.
I totally agree. I think the name of the game going forward is investments that are, safer and less speculative, but very importantly, generate inflation adjusting income streams. And real estate's a really good example of that, where rents usually can go up roughly to match the rate of inflation. I did a video on that, explainer video of that a couple of weeks ago. But I think, George, that honestly, besides, some other really conservative investments and, hard assets, commodities, the type of things that should be somewhat of an inflation hedge, that's really about one of the best strategies out there right now.
Yeah, I agree. So let's talk about the thin ice for a moment here, that most people think is concrete. We briefly discussed the Fed put. I want to get to that in a moment. But today, if I'm not mistaken, Powell is going to come out with a statement. They've got a meeting where he's not going to do anything to interest rates, but he's going to come out and give an official statement that the media is going to latch on to, and everyone's going to be hanging on their every word as to what their tapering might look like in 2022, how fast they're going to taper, if they're going to potentially raise twice, 3 times. Maybe he might give some insight on that. So I want to get your opinion on kind of the different direction the market might take, if he's dovish or if he's takes a stance that's more hawkish. But then also, I want to try to think through what happens if he does raise interest rates 3 times in, let's say, 2022, which I think is what Goldman Sachs is predicting. So understanding that he can't just raise rate, well, I guess he could, but what he'd most likely have to do is taper down to 0 first and then go ahead and raise rates. So if you're saying that he's going to raise rates 3 times, you're implying that the tapering of QE is going to go all the way down to 0 first. So then we've got 2 things there. We've got the tapering potentially impacting the stock market, because we know that QE has been very good for it, whether that's directly or from a psychological standpoint. And then we've got the increase in interest rates. That's not good usually for PE multiples. So, I guess kind of give me your take on today. And then if they do taper and then get rates going higher, what does that do to the stock market, do you think? Probabilities.
Yeah. Okay. So not only do I think it's a great question, George, I think it is the question.
Yeah.
And by the time this airs, we'll have clarity into this. So it'll be interesting for folks who are watching this. They'll be able to interpret our predictions here with what's actually happened. So I guess I can't emphasize enough what a 180 the Fed's language has taken in really just sort of the past couple of months here. I mean, for the past 10 plus years, the Fed has been nothing but dovish and nothing but everything is under control, everybody, right? And even at the beginning of this year, when people like us, were warning about inflation, Fed shrugged it off. It's going to be transitory, folks. Don't worry about it. Of course, at the last meeting, Powell famously, retired the word transitory. Finally, the Fed doesn't often. That's about as close as it's ever going to come to admitting defeat. But I think the really big question here is, no matter what the Fed says, can it actually tighten? And quick difference between tapering and tightening. Tapering isn't tightening technically, right? Tapering is just putting less stimulus into the system. And what the Fed is currently committed to is taking, it was doing 120 billion a month in asset purchases. It's now, I think, doing about 105 billion. And the current plan.
So they subtracted 10 of treasuries and 5 mortgage-backed securities.
Exactly. Yep. And then, so their current plan is to continue to do that until there's no more tapering to do. And that trajectory gets them to 0 at about June of next year. What people are thinking the Fed could announce later today is sort of a turbo taper, right, where they increase that number, and folks are kind of ballparking, they might double it to 30 billion a month. And that'll get them down to 0 by about March or April of next year. Now, first question of can they get away with this, right? When Jerome Powell started to this very slow process of reducing the Fed's balance sheet back at the end of 2018, we had the famous taper tantrum, and Powell did an immediate, 180 in terms of policy and went right back to easing, right? And then the coronavirus hit a little bit later, and of course the rest is history. We're at 8 trillion now, or whatever the current balance sheet number is. So one is, will markets, have they seen the script, right? They just know that we have to just sort of throw a big hissy fit, and that the Fed is just going to, reverse policy right away. That remains to be seen. I'll talk a little bit in a moment about how I don't think that the markets can stand much tapering, and certainly not much tightening. As you said, I think the current, jawboning of the Fed, I don't know if they're fully committed to it, but enough that the banks are now projecting a 2 or 3 rate hikes in the back half of 2022. And then perhaps 3 more additional ones in 2023. I mean, I'll tell you right now, I just don't think that's going to happen, George. That is so far afield of what the Fed's been able to do, since the days of the great financial crisis. I mean, really, since the days of Alan Greenspan, we haven't seen a tightening regime, and the system is so much more unstable now. Both markets are addicted to low rates. They're addicted to, you know, pervasive and consistent stimulus, and they're addicted to cheap, practically free debt, you know, which they can use to lever up to do share buybacks and all that stuff that's driven asset prices to the historic levels of valuation that they are today. So I think there's a really good question to be asked is just, hey, if you just take away the stimulus itself, forget about raising interest rates, can market prices stay elevated where they are right now? And then when you throw interest rate increases into the mix, God, I just don't see how they can do anything but correct, and I think correct very substantially. And so the real question here is what's the Fed really going to do here? And what I hate about all this is we can't be investors anymore. We can't look at a good company and assess its prospects and then invest accordingly. We have to try to figure out what a small number of people in the, you know, boardroom of the Fed are going to decide to do next. That's all that really matters to market pricing at this point, which is ridiculous. So, you know, like I said, the Fed is either going to bulk, as it has always done, you know, in recent history, or if it actually gets serious about trying to tame inflation and it starts raising rates, we are in an entirely new regime. And that's a regime where everything that's worked for the past, you know, 12 plus years in the markets is going to stop working anymore. You're going to see massive losses in the highly speculative high flyers, the big tech growth stocks, the cryptos, you know, all the stuff that's been pumped up. You know, it's going to be Armageddon for a while. I think it's probably going to take everything down with it, but the more speculative companies first. And then we'll see what happens from there. And I'll just tell you, you know, people ask me, what would I like to see? I mean, let's be honest about this, George. In a real world, the market wants to deflate, right? It's been so distorted by the central bank interventions over the past couple of decades. There is so much malinvestment out there that needs to clear the system. And if left alone, the system wants to deflate and get rid of all that stuff. The problem is no sitting politician or Fed chair or whatever wants to preside over that, because they will never get reelected. It's going to be political suicide, because that austerity is going to be super duper painful. There's going to be massive portfolio losses. Companies are going to go out of business. Jobs are going to get lost. It's going to be really painful. But that, I think, is what's needed to get back to a sustainable baseline where we can maybe live within our means a little bit more and get back to the business of true investing and free and fair markets. Do I think that's going to happen? No, I don't think people are in power are willing to let that happen. And so I think, all things being equal, I put much higher probability on going down the inflationary route. Now, they're going to have to tame inflation from just going bananas, because that's what social revolutions are made of. But I think they're going to try to thread a middle course where inflation is under control enough that the pitchforks come out, but that it keeps enough of the status quo in place for the folks that are running the system that they feel like they can keep their jobs. Are they going to be successful at that? I don't know. And, you know, I just kind of see us sort of perched on the knife's edge here, trying to figure out which way we're going to go. Are we going to collapse in a deflationary, just vortex that brings the system back down to eventually where it needs to be? Or are things going to get away from a Fed and we're going to have a runaway inflation that just destroys our currency? And sadly, neither is going to be pleasant to go through.
Yeah, if you believe their mandate, which I don't, you know, the price stability, I think they've that ship has sailed a long, long time ago. But I think their number one mandate would be asset prices. You know, that in their minds, you know, that's their number one mandate. So how do you combat inflation, or even can you combat inflation, if your number one mandate is asset bubbles? That's the position they're in right now. So then the way I think about that is, let's say that we have a down, and for the Fed, it's all about not the stock market just going down, but going down disorderly. I think that's the word they use. So if you think about the taper tantrum, I think it went down, S&P maybe 20%, something like that. But let's just envision a world where they get down to, like, let's say the magic number is 20 billion a month. So they go from 105 down to 20. They don't even raise rates yet. But then the market starts freaking out and goes down by 20%, gets into bear market territory. What do they do? What do they do, assuming for a moment that the CPI is continuing to go up?
You know, it's a great question. It goes back to, can the Fed actually taper or get any of this under control? I'm sure you've used those words on your program in videos past too, is the Fed really is in a trap of its own making, right? They've painted themselves into a corner. Their game has been to just kick the can a little bit further down the road as much as possible every time. But you get to a point, and it's looking like we might be arriving there, where the road's ending and there's just no way to kick the can anymore. And honestly, George, I don't know what the Fed would do in that scenario. What's interesting about inflation is that is the boogeyman for the Fed, hot, high inflation. Again, because that's when inflation becomes a political problem for those folks that are running the system. And right now, there's a poll that just came out over the weekend. Biden's 69% of voters disapprove of how Biden is handling inflation specifically. And I'm certain that what's been driving, Powell's tougher talk about tapering and maybe tightening is a ton of pressure that he's getting from the White House, right? And that's only going to intensify as inflation continues to rage. And George, even if they take like really aggressive steps right now, it takes about a year for policy changes to really get reflected in the inflation numbers. So we're going to be living with higher inflation for a good while. And most of the folks I talk to expect that inflation is going to be higher in 2022 than it's been here in 2021. So it's not something that could be easily solved. So
let me throw you a curveball really quick.
Sure.
I was having dinner with my good buddy Mark Moss, who also lives in Puerto Rico, and we were having this exact discussion and trying to think through, what do they do? And Mark said, well, I think they may go to the nuclear option. And he actually did a video on this to say, okay, what's the nuclear option? He goes, well, that's the third thing that we haven't discussed. He goes, price controls. So not that the Fed would do that, but the government. So if the Fed gets back, think about that. They're backed into a corner. They can't raise rates, or they can't continue to reduce the size of QE, because that will implode the market. But they can't, do more QE. They can't do anything to fight inflation, right? They can't raise rates. So then the government comes in and says, okay, what we'll do is just implement price controls. So then the Fed can continue to support the stock market while we can try to tame, or that'll be the solution for inflation. What do you think about that?
Yeah. So who agrees with that is Grant Williams. So
and Russell Napier, I know, has said that too.
Yeah, I just interviewed Grant last week, and he said this is exactly what's going to happen. And of course, it's sort of a precursor to, ultimately doing the right thing, right? So none of this will work, right? I mean, we don't really have a lot of examples where this has successfully sort of righted the ship for people, but it's sort of, the act of a desperate administration is they will do everything possible before they do the one thing that they know may actually work, but will likely get them voted out of office. But it's price controls, it's capital controls, it's maybe forcing everybody who's got a retirement account or a pension to invest that in certain new types of bonds, and it'll be sort of looked at as your patriotic duty towards fighting inflation and whatnot. So I'm sure we're going to see a lot of that. I just don't expect it to work at the end of the day. So yes, I expect it. I guess where I was sort of going earlier is my only hope in this storyline is that you either get a president, which I have less confidence on, or you get a Fed chair that just says, all right, you know what, I'm going to try to go down in history as the guy who, did the right thing in the end. And even if it sort of toasted my prospects. Yeah, kind of like a Volcker 2.0. Coming into his office, I might have thought Powell could have been that guy. At this point, I don't think he can be, based just judging on his actions to date. But there's an old Winston Churchill quote that I'll kind of conclude with here, which I love, which someone asked him his opinion of Americans. And he said, So I love Americans. You can always count on them to do the right thing after they've exhausted every other possible option out there. And I kind of get a sense that applies to the, our authorities who are running this stuff. Is I think at the end of the day, hot inflation is going to force them to do the right thing by pulling the Volcker playbook, out of mothballs. But they are only going to do that when it's the last absolute option. And honestly, I think the thing that's going to force them to do that is going to be the public. I think that the pitchforks will finally come out, and it's really going to be sort of hey, we have to do this, or the nation gets rent asunder.
Yeah. What that reminds me of is when I was in St. Bart's at the end of 2020, I was trying to find a little bit of freedom, and they were pretty much wide open. So I got to spend a lot of time with my good friend Hugh Hendry. And I remember at the time.
That's right. He's there on St. Bart's. Yeah.
That's right. Yeah. At the time, he wrote a paper, and I don't know if this was the title of the paper or the theme, but his proposition is that Joe Rogan should run the Fed. And he said it kind of tongue in cheek. And back then it was kind of just like funny. But now it actually makes a lot of sense when you think about what's happening just a year later.
Well, look, we don't
Maybe
have
that's the answer, Adam. Maybe we need.
Well,
Joe
hey,
Rogan
look, he couldn't do a worse job, and I suspect, honestly, I think an empty chair would do a lot better. I mean, why not just have market forces set interest rates and just basically say, look, we've had the Fed do this for long enough that we know it didn't work very well under them. So why not let the market do this?
And at least you'd have someone there that the majority of Americans, I think, would believe that he would try to do what is right. Regardless of how unpopular it may be. So maybe there's something to that. But the next question I want to ask you is if the Fed put has expired, because I have kind of a theory on that as well. But we're going to save that for the second half of the video on Adam's channel. So Adam, what's the name of your channel? So people can just shoot over to your channel right now and check out the video. So how do they get there? What's the name of the channel?
Absolutely. So folks, the name of the channel is, the name of the business is Wealthion. That's Wealth ION. And it's just youtube.com/Wealthion. And you're exactly right, George. We'll be running part 2 there right after this one concludes.
All right, guys. So head over there and we'll see you on the next video. Hi, guys. I'd like to invite each and every one of you to the next Rebel Capitalist live event. If you are a fan of the Rebel Capitalist show, I guarantee you will love the live event. The next one is Houston, where you can meet and listen to speakers, all your favorites from the Rebel Capitalist show. People such as Dr. Ron Paul, Chris Cole, Lynn Alden, just to name a few. If you want to check out the rest of the speaker list and find out how you can attend, we'll put a link in the description below, or you can just go to rebelcapitalistlive.com. This is an event where you can learn to build wealth and thrive in a world of out-of-control central banks and big governments. But it's not just about building wealth. It's about increasing your freedom and networking with like-minded individuals, fellow rebel capitalists. It's an amazing event. I know you'll absolutely love it. Check out rebelcapitalistlive.com, and I will see you in Houston.